All right, let's talk about Quantum Corporation. Today, we're digging into their fiscal first quarter earnings call. And let me tell you, it was a wild one. You've got a classic story here. A company's actual performance versus what they're promising is just around the corner.
And Wall Street, well, they had their say, and it was swift and brutal. The stock absolutely cratered, dropping almost 17% right after the report. Now, a move that big isn't just disappointment. That's investors basically saying, we're out. They were running for the hills.
So that's really the heart of our breakdown today. We're going to unpack this huge disconnect between the market's panic and the new CEO's incredibly optimistic game plan. You got to ask yourself, is this a falling knife or is it a coiled spring ready to pop? Let's figure it out. Okay, first things first, let's get into the numbers themselves. A quick look at the results and you'll see exactly why investors got so spooked. I mean, these numbers weren't just a little off, they were way off.
Wow. I mean, just look at the size of the miss here. It's kind of stunning. Revenue landed at $64.3 million, missing the street by almost $6 million. But, the real jaw-dropper was the bottom line. The earnings per share was a loss of $1.58. The consensus was expecting a loss of maybe 15 to 43 cents. That's not a miss, that's a crater. You just can't spin that.
And you can see here, the pressure on the top line was very real. It wasn't just about missing this quarter's estimates. Revenue was down nearly 10% from this exact same time last year. In the tech world, if you're not growing, you're going backwards. And a drop this big makes everyone start asking some really tough questions. Okay, so the numbers were grim, right? But here's where the story takes a turn. The new CEO, Hugues Meyrath, stepped up on his very first earnings call and laid out this incredibly clear, aggressive plan to right the ship. Right away, Meyrath just set a completely different tone. And this isn't some rookie CEO. This guy is a longtime industry vet who's seen Quantum from every possible angle, as a supplier, a competitor, and even as a board member. His message was simple and direct. The era of excuses is over. It's all about doing what you say you're going to do and doing it fast. And he wasn't just talking. In his first 90 days, the guy made some huge moves. First, he fixed the balance sheet, raising $83 million and paying off their entire short-term credit line. Then, he started cutting costs to get expenses way down. And maybe most importantly, he cleaned house, bringing in a new chief revenue officer and stacking the board with some serious experience. This is a total reset from the ground up. And this, right here, brings us to the central drama of the whole story. You've got a new boss making all the right moves on paper, but you've got a market that's basically pricing the company like it's going out of business. This is the battleground for the stock. And you can see that contrast so clearly right here. On one hand, management is promising to get to approximately break-even on their operating profit next quarter. That's a massive swing from losing $6.5 million. But on the other hand, what did the market do? It just hammered the stock down 17%. It's like the market is screaming, "We don't believe you." So, how does this all get settled? Well, it's going to come down to hitting these key milestones. The big one, the most immediate one, is next quarter. Do they actually hit that break-even target? After that, we need to see proof. Proof that the new sales team can stop the bleeding on revenue, that they can get their debt situation under control. This is basically their report card for the next few months. So let's look ahead. The next earnings call is just about 3 months away. How should we be thinking about this stock? What's the move? All right, let's put it all together. We're going to give you our forward-looking thesis and a rating, just like you'd see from a big Wall Street firm. Okay, so we are initiating coverage with a market perform rating. So why not something more aggressive? Well, the CEO's plan is solid. It's a textbook turnaround, and it's exactly what you'd want to see. The problem is they have to actually do it, and that massive earnings miss tells you that the risk of them messing up is still really, really high. So for now, the bull case and the bear case feel pretty balanced. So, what's our crystal ball say for next quarter? We think there's actually a pretty good chance they will hit that break-even goal. Why? Because cutting costs is the one thing you can completely control. But stabilizing revenue, that's way harder and takes more time. So we're expecting another soft sales number, which probably means the stock is just going to tread water until investors see real, actual growth. And now for a potential trade idea. And let me just say, this is for investors who are comfortable with a good amount of risk. You could look at selling out of the money puts. In simple terms, you're getting paid a little bit of cash today for agreeing to buy the stock at an even lower price later on. It's basically a bet that the CEO's guidance about breaking even will put a floor under the stock and keep it from falling off a cliff. It's a show-me kind of trade.
And as always, just a friendly reminder, this is not financial advice.